Hey traders and investors, it's Serge Berger here. Earlier this week I talked about the current environment, the current market environment, how very much of it is dependent on the interest rates and the rising dollar that we've seen over the past week or so. And basically I wanted to quickly give a heads up on the move that we saw in banks in the past day or two and how that translates, or how we need to risk manage that when it comes to next Wednesday's FOMC meeting, which pretty much looms large and could make or break this entire move, or at least part of the move in the dollar and a good move and the good part of the move that we saw in interest rates. And of course, that'll translate into the way equities trade as well. So let's have a quick look at that. Understand that yesterday on Thursday, March the 12th, what we had was the banks had a very good rally. Look at the KBW Bank Index. You can see very nice pop here on the day. There was some news out of basically stress testing and some dividends and just basically shareholder returning cash to shareholders, and that was received very favorably by stockholders of, say, Morgan Stanley, Citigroup, and American Express. More importantly, though, is what we need to see now, because next Wednesday's FOMC meeting is, as I said earlier this week, is really we're really at a point here where we can have a structural shift for the first time in years as far as what the Fed is doing. In other words, if they do really pull through with this more hawkish view, which I'm still not sure they will, but the risk is there, then this entire move higher in interest rates may actually stick. So I think a 10-year Treasury note yield was at about 2.65 or so just at the beginning of February. The top ticked around 2.25 just a few days ago, and so the question is whether the Fed is going to confirm this low here. So if they do, then interest rates will go higher, banks will probably go higher, and the stock market will probably initially pop, and then at some point continue to go down because the dollar will go higher as well. So to make a long story short, do not trust this breakout in the financials that we saw the other day just because it's not confirmed. Janet Yellen can completely turn this thing upside down if she wants to on Wednesday. So please don't rush into this. Even though we had some very good moves, say for example in the regional banks. Look at the KRE, very nice move here, both in absolute terms and also if you were to look at this in relative terms. We use a little something called a ratio chart, where we just take the KRE regional banking ETF and divide it by the SPY, which is the S&P 500 ETF. You can see, if we roll this back a little bit, a very nice technical move or relative strength move that really looks to have sustainability here. Again, we need to have this confirmed by the Fed on Wednesday. So please don't rush into this and try to front run the Fed. Front running the Fed is one of the worst things we can do. So let's wait for confirmation from Yellen. If she confirms that they really indeed are going to raise interest rates, and I suspect financial stocks will continue to rally, and of course interest rates will as well. If they don't, then a lot of this will reverse, and we'll have to reevaluate whether we want to buy lower or just go short altogether. I hope this makes sense, guys. Again, keep in mind that trading and managing your life, your money, is a lifestyle. If you get any questions, head on over to thesteadytrader.com or shoot me a message via Twitter. My Twitter handle is steadytrader, and I'll see you in the next video.